Hello, my name is Jonathan Allen, making my presentation today, July 16th, 2026. Today I'm going to talk about covered call writing, some of our puts for our hedging, and the power of incremental performance. So let's get into this. So what is covered call writing? So what we're doing is with our strategy is we're buying index funds. We're buying like SPY, we're buying the NASDAQ 100 via the QQQ. We can buy levered options or levered variations of those, and we can write covered calls on them. So writing covered calls is essentially we're doing a couple of things. We first of all we would buy the ETF. We would then write the covered call. The covered call is giving us income. So we're selling a call option against our ETFs, and that is generating cash for our positions. This cash can be used to boost returns. It can be used to cut down on the cost of the puts, which is the insurance. But big picture, that is what we're doing. So this is just an example here, but let's say, for example, we had a $50,000 position. We had 100 shares of whatever at $500 value per share. That's 50,000. If we wrote a call that was 1 month in advance into the future, that was 5% out of the money, we would generate about, and based on just this example, $400. So $400 divided by 50,000 is 0.8%. So that is the return that we would have generated monthly for this position. Now, if we did that over 12 months as an example, we would have generated 9.6%. The thing is, now this is just an example. Like most of the covered call writing I'm doing is I'm giving us, 5 to 6% out of the money. Realistically, we're getting about 0.25% to about 0.6%. So 0.8 is high, but this is just an example. The thing that happens though when we write covered calls is it's capping our upside. So if, for example, we sold a covered call 5% of the money, and a month from now that stock or ETF position is has appreciated 10%. So there's a 5% gap there that we lost out on. So basically, we're selling the upside, right? And we're getting a premium for it. But the risk is that we could, we lose out on any percentage that's above the call that we wrote. So if it were to go to 8 or 9, 10%, there's a difference there that we're missing out on. So if you go to my benchmark tab on BelvederInvestmentsCO.com, you'll see you're not going to see the right picture, but you'll see the left. The left picture is just showing kind of like, let's say base case, average S&P 500 index fund, average for the S&P 500 over the last, however many years has been 10%. That's the base case. So you'll see we start with 100,000, we get up to $1,083,470.59. If we were to add, 1, 2, 3, 4, 5% via our covered call writing, you can kind of see the difference in the values of your account potentially over time. So, generating 5% or 15% if the base case, if the average is 10%, is really high. It's a really rich, scenario. But if we can get 12, 13%, you can see the difference there, right? You're looking at $700,000 to $1.1 million more over a 25-year time span based on this example. So that's really what we're trying to do at Belvedere. We're trying to give people incremental performance. So it's not sexy, it's not stock picking, but we're trying to inch every month, generate income via our covered call writing with our index funds to get us to that 12, 13%, maybe even 14%. In this example, 1 to 5% incremental performance. That's really what we're looking for. If we can generate 10 to 20% above the benchmark over a long period of time, that is ideal, right? I mean, the best managers in the world, I think Bridgewater, I think their average return is like 12% over since inception. So, I mean, if we can get 12%, that's really doing good. Let's see. So on the picture on the right, that's our hedged equity, put option calculation. So what this is showing is how we calculate how many puts to buy, how much equities to buy, um, the cost of all those, how many contracts we need, what do we do between the contracts that is technically needed, 61.195 versus what we're actually going to buy. So you can't buy half contracts, or at least I've never heard of being able to buy half contracts. So this is what I would do at my old firm is my job was to calculate the number of contracts that's needed, the amount of equities we need to buy, and basically calculate the downside. So in this example here, have a downside buffer of 0%. So or 0.66% if you want to get technical, based on my assumptions there and my calculations. So I can make your downside 0%. I can make it 5%. I can make it 10%. I can make it 20 or 30%. It all matters on your risk tolerance, what you're looking for, your time horizon. I can make that happen. I just need to know you, the client, your situation, and what you're looking for. Let's see, what else? Yeah, so basically, if there's any difference, so if we can't afford a full contract, basically that buffer there, or not the buffer, the whatever the dollar amount is, so take whatever left over. In this example, it was $68,667. That could go into another ETF. It can go into VWIX, VWENX. These are other mutual funds. That's where the money could be held. So this is the calculation. I have a spreadsheet for this. I have a spreadsheet for calculating, allocating more capital, raising cash. I have several different spreadsheets depending on the scenario and what we're trying to achieve. So this tab here, or this slide here, goes into performance across market regimes for writing covered calls. So writing covered calls is best done when the market is flat, it's range bound. It's just like earlier this year before we had that huge bull market run, the market was very flat, right? The volatility was very low. Writing covered calls, even 3%, 4% out, 5% out, worked really well. When it doesn't work really well is when it's extremely bullish. Because if you're moderately bullish or sharply bullish, right, then it's just going to blow through your strike price, and you're going to miss out on the difference between your strike price, whatever that is, and whatever percentage it goes to. So if we give ourselves a 5% runaway and it goes up to 8%, there's a percentage difference there of about 3% that we would be missing out on. Roughly, right? I mean, I'm not taking into account the premium there, but you're looking at a roughly about 2 to 3% that we could potentially be missing out on if it were to go above our strike. So also on this slide, I'm going to take the opportunity to go over what our strategy in general, right? When does our strategy work? When does it not work? So our strategy in general does not work well or collars don't work well when it is range bound between +5 and -5. If the market, if SPY or QQQ is in that range, the cost of our puts could potentially be 3, 4, 5%, maybe even more, depending on the situation. That is a situation when our strategy does not work well. You would probably been better off just buying the index. But most of the time, good news, most of the time it's not in that range. It's usually either above 5% or it is well below 5%, like 2022, 2008. So most of the time it's not in that range, and most of the time our strategy does work. But this is when, so if we're buying, this is when we buy the puts. What we do is collars, right? So we're buying puts, we're selling calls. The selling calls, as I said earlier, can be used to boost your returns, but it can also be used to pay for your insurance. So the idea is if we're doing collars, we would love to have a net neutral or a costless insurance, right? We would love to be able to write these covered calls and pay for your insurance in part or in whole. So what are you giving up with writing covered calls? So we're getting upfront realized cash premium from that. This can help smooth out your returns. It can help boost your returns. It can help pay for your insurance. If we're doing this disciplined over monthly or quarterly or semi-annual basis, this can help boost your overall performance of your entire account. What you're giving up though, so like I've already mentioned, right? So if the market, if SPY blows through our strike price, if we've given ourselves a 5% runway and it goes to 7, 8, 9%, we've missed out on a couple percentage points of return there. So their strategy really works best when it's not volatile, when it's pretty smooth, when it's pretty neutral like it is right now, to generate income. So this is an example of an actual position I had in one of our paper trading accounts, and this is for QQQQ. We had $5 million. We deployed that. This goes back into the other slide, a couple slides back, where it showed the calculation of how we calculate the puts, how we calculate the amount of equities, how we calculate the downside. This kind of goes into that. But here, I'll go into the next slide. But this is kind of goes into the downside, the floor, the income overlay or the income offset with the cover call writing, and the amount of capital that is deployed with this collar. So as you already saw on a previous slide, this kind of goes into that. This is a more detailed, I guess, larger version where you can see it. But I use this strategy. I use this spreadsheet for everything when it comes to, writing collars, when it comes to doing collars, when it comes to buying the puts. So if you give me $10 million, if you give me $5 million, I'm going to use this spreadsheet to calculate the amount of contracts we need to buy, the amount of equities we need to buy, the amount of the dollar cost of the puts, everything, right? Anything that's left over will go into either mutual funds like the 68,667. It can go into ETFs. We're not, this is a strategy that I used at a previous firm called Healy Wealth Management, where we managed about $100 million. It was mainly in single stocks, but we used put options to manage the risk. So this is a really great strategy. I really like it a lot. I have another spreadsheet I use for allocating for raising cash, for allocating cash. It can get, I wouldn't say it's not complicated, but you got to kind of know what you're doing. Because if you calculate the amount of puts wrong, if you calculate the amount of equities wrong, the strategy won't work as well, right? You could really open yourself up to a lot of liability if you thought your downside was X amount, right, whatever that is, but it was actually a lot more. So you kind of got to monitor your funds throughout the strategy, throughout the 12 to 18 months that you're running it before you re-hedge. So here's the key takeaways from this, what I've been speaking about. So this is mainly on covered calls. So basically, what we're doing is we're selling the upside, and for selling the upside, we are going to get a premium for that. That premium is going to be used to boost the return. It's going to be used to offset the cost of the puts if we bought puts. We don't have to buy the puts, right? If a client is specifically just in QQQQ or SPY, we can take that capital and not buy puts and just write cover calls on their portfolio. But with that, right, we're going to be capping the upside. So you're selling away the upside for premium, right? So we try to do things in such a way where we have a 70 to 85% chance of the trade going our way. We have calculations we do on the back end. Interactive Brokers gives us a spit out of the probability of our trade being a success. So we try to do everything where we're writing income for you while not capping your upside. So we're about at 15 minutes. I'm going to cut this one today, but thank you for listening to my presentation. If you have any questions on covered call writing, if you have any questions on put hedging or our strategy in general, please reach out to me. My email is john@belvedereinvestmentco.com, or you can call me at 865-375-3027. Thanks. Bye.